Hello to Finance House. It's the 29th of December, 2025. The view outside might be icy, but the topic we're discussing today is absolutely white hot: the silver market. As we look ahead to the market's opening tomorrow, there's a simple, urgent question on everyone's mind. What is going to happen with the price of silver? To understand where we might be going, we first need to look at what just happened. Last week, something very, very unusual occurred. The price for an ounce of physical silver in Shanghai, China, and the price for an ounce of silver in New York, USA, moved far apart from each other. Now, usually these prices are very close, maybe differing by $1 or even less. But by the end of trading before the Christmas break, the price in Shanghai was nearly $8 higher than the price in New York. This is a massive signal. In a normal, healthy market, this just wouldn't happen. If silver is cheaper in New York, big trading firms would immediately buy it there, ship it to Shanghai, sell it for the higher price, and make a risk-free profit. That act of buying in New York would push the price up, and selling in Shanghai would bring the price down until they came back together. The fact that this huge gap has not closed and has actually gotten wider tells us one thing very clearly: that simple trade is not happening. It suggests there is a serious shortage of physical silver that is readily available to be moved and traded. The metal is simply not where it needs to be. The shortage isn't some sudden surprise. It's the result of a trend that has been building for years. Simply put, the world has been using more silver than it has been taking out of the ground. For 5 years in a row now, global demand from industry and investors has been greater than the new supply coming from mines. To fill that gap, we've been using up the existing stockpiles of silver, the bars sitting in vaults in London and New York. And those stockpiles have been getting smaller and smaller. So why aren't mines just producing more? The main reason is that silver is mostly a byproduct. Only about 20 to 30% of silver comes from mines that are primarily looking for silver. The other 70 to 80% comes as a bonus from mines that are really digging for other metals like copper, lead, or zinc. So if the price of copper is low, a copper mine might slow down or even close, and the silver that would have come with it just never appears, even if the silver price itself is soaring. The supply of silver is tied to the fortunes of other industries, making it incredibly hard to increase quickly. Now, let's talk about who needs this silver, because this is where the story gets critical. Silver isn't just a shiny metal for jewelry or coins. It is an absolutely essential industrial material. The solar industry is the biggest single consumer. The special silver paste is a critical part of every single solar panel. The companies that make these panels need a steady, reliable flow of silver to keep their factories running. The electronics industry is next. Silver is in almost every advanced device: your phone, your computer, your car's electronics. It's the best conductor of electricity we have, and for many of its uses, there is no good substitute. The automotive industry uses more and more silver every single year, especially in electric vehicles. Each car might only have an ounce or two, but when you're making millions of cars, that adds up to a huge amount of metal. Here is the crucial point. For these massive companies, the price of silver is almost secondary. What they cannot survive is not having the silver at all. If a solar panel factory runs out of silver, the entire production line stops completely. The cost of stopping a billion-dollar factory is far, far greater than paying a bit more for the raw material. Because silver makes up such a tiny fraction of the final product, its cost, even if the price doubles or triples, it only adds a small amount to the price of a car or a solar farm. These companies are what we call price insensitive. They will pay whatever they need to in order to get the metal and keep operating. This creates a potentially dangerous situation. For years, these big manufacturers have operated on just-in-time supply chains. They might only keep a few weeks' worth of silver on hand, trusting that they can always buy more on the open market. But what if the market suddenly doesn't have it? The widening price gap between Shanghai and New York suggests we might be in that exact moment. If you are the purchasing manager for one of these companies, you are not looking at price charts right now. You are probably on the phone desperately trying to make sure your company has enough physical silver to operate through January and February. If many companies start doing this at once, trying to buy and secure physical silver for their stockpiles out of fear, it could create a buying panic. They stop being simple shoppers and become desperate competitors in a race for a very limited resource. Meanwhile, in the financial world, another problem is brewing. The COMEX in New York is where a lot of paper silver trading happens, through futures contracts. People buy contracts that promise the delivery of silver in the future. Right now, the amount of silver represented by all these open contracts is enormous, about 750 million ounces. But the amount of silver actually sitting in COMEX warehouses and ready to be delivered against these contracts is only about 113 million ounces. That's a huge mismatch. For a long time, this wasn't a problem because most people who buy these contracts never actually take the metal. They just sell the contract before it expires or roll it into a new one. But what if that changes? What if, because of all the stories about a physical shortage, more and more buyers decide, you know what, I want the actual metal. Please deliver it. If too many people ask for delivery, the system simply won't have enough metal to go around. This could force the exchange to step in and settle contracts for cash instead of silver, which would throw the carefully laid plans of those industrial users into chaos and send them rushing into the physical market, making the shortage even worse. The timing of all this is also incredibly tricky. We are in the holiday period between Christmas and New Year. Trading desks at the big banks and funds are lightly staffed. The senior traders are away, and the junior people left behind often have strict orders not to take big risks. This means the market is thin. There are fewer buyers and sellers available to absorb big trades, so if a large order comes in to buy or to sell, it can move the price much more violently than it would on a normal busy day. We could see huge price swings up or down, not based on deep analysis, but simply because the market has no shock absorbers right now. Adding one more layer of pressure, China, a huge consumer and also a producer of silver, is about to implement new export controls on the metal, starting January 1st. This means they will be keeping more of their own silver inside the country to feed their massive solar and electronics factories. For the rest of the world, this removes a potential source of supply just when it is needed most. So, as we look to tomorrow, we are facing a perfect storm. We have a clear signal of a physical shortage from the east-west price gap. We have a years-long structural deficit that has drained stockpiles down to critical levels. We have industrial users who are terrified of their supply stopping and may be about to start panic buying. We have a paper market where the promises of metal vastly exceed the available supply. We have thin, nervous holiday trading that amplifies every single market move. And we have a major geopolitical decision that will further tighten global supply. Will the price go limit up or trigger circuit breakers on Monday? It is certainly possible. The market's mechanisms to prevent a runaway price are designed for normal times, and these are clearly not normal times. The real force at work is no longer just speculation. It is the fundamental, non-negotiable need of global industry for a material that is proving to be incredibly scarce. The paper market is trying to price this reality, but it is the physical market, the actual bars of silver, that will have the final say. This isn't just a story about investors. It's a story about the foundations of our modern technological world and how a shortage of one quiet, critical element can send shockwaves through the entire system. The opening bell tomorrow isn't just the start of a new trading week. It may very well be the next chapter in a story that redefines the value of this essential metal. Thanks for watching, and be sure to subscribe for more updates as this story unfolds.